Making news in the market this year has been the high number of so-called corporate actions, such as IPOs and mergers and acquisitions. Another type of transaction making headlines recently is the stock spinoff. In this morning's U.S. Bank Economic 360, Mike Denneman, Vice President and Senior Portfolio Manager for U.S. Bank, joins Business Courier editor Rob Dawmeyer in the studio. Mike and Rob.
Peg, thanks. Mike, thanks for being here.
Morning, Rob.
What is a spinoff? First of all, and why would a company want to do a spinoff?
Sure. So it's really a pretty basic transaction, really. Most corporations in the U.S. do more than one thing. They have multiple subsidiaries, they have different divisions, and on occasion, management will decide that one of those subsidiaries or divisions just doesn't fit in with the business model anymore. Could be for any number of reasons. Maybe they just simply make a product that the company is no longer interested in marketing. So what management can do is create a brand new company that houses only that subsidiary. They then issue new shares of stock for that company and pass them out to the current shareholders. So that's the spinoff. And investors find themselves then owning two separate companies, the original parent and then the new spinoff, which is now a completely separate standalone entity.
So we're talking about shareholders. Is this something shareholders typically should like, or is it a sign maybe that something's going on that isn't happening the right way?
Sure. Well, I would say in general it's a positive thing, or at least a neutral. Certainly there can be bad spinoffs. There's examples, of course, where companies will spin off subsidiaries that are total lemons, so you have to be cautious for that. But generally it's beneficial for both companies. For the parent, it no longer has the distraction of a subsidiary that it wasn't making a priority anyway. And for the new spinoff company, it now has its own management, it has its own shareholders, so it can focus on what it does, its very narrow business line, without worrying how that fits into a larger corporate umbrella.
So what should a shareholder do? If I've invested in a company that I've done some research on, or that my broker, my bank has done some research on, then all of a sudden, I have shares in a company that I don't know much about because it was a part of a business that maybe I didn't know much about. What do I do?
Right. Well, there's some practical considerations first off. You have to remember that the spinoff is going to be a very small slice of the original parent company. So if you own, say, 100 shares in the parent company, you can't expect to get 100 shares of the spinoff. You're going to end up more with 5, maybe 10 shares. So for many investors, that's a nuisance. I mean, really, who wants 5 shares of a stock? So many will just impulsively sell those shares immediately, and that creates pressure on the share price. It holds it down artificially as everyone's selling these shares right off the bat. But for patient investors, if you hold on to those shares, if you wait for that initial selling to die down, oftentimes you'll start to see the share price of the spinoff begin to rise. In fact, many studies show that over time, the spinoff will begin to outperform the parent. So I would suggest don't sell it immediately.
Right.
Be patient, give it some time, look into it, find out what the company does, what its prospects might be, because oftentimes, even though the parent didn't want it, these spinoffs are diamonds in the rough.
Yeah, sounds like great advice, Mike. Thanks for being here.
Thank you.
Peg, back to you.
All right, Rob and Mike, thanks.